Yes, please go ahead.
Okay. Good afternoon, good morning, and good evening, everyone. This is Joseph Trevisani from FX. Actually, no, it's from Worldwide Markets. Sorry. FX Solutions was our own company, old company, which I'm sure you all know about. At any rate, we have an interesting topic today. I call it rather quaintly or cutely, what's a technical analyst to do? You can see from my chart what I put up there. It has a couple of lines on it, but it's basically a list of our central bank bankers, either officially, meaning on the schedule from the FOMC and the ECB meetings, or from various talking that most of them do, jawboning as it used to be called. It would seem from now, by the way, just a couple of bookkeeping notes. I'd like to thank FX Street for putting this on, of course. I have chat up here, so if anyone has any comments, criticisms, jokes, anything you'd like to do, please type it in. I will check the chat periodically, and I'll be glad to answer any questions or go off on any direction that any of the people who are listening find illuminating or anything else. Jokes are always welcome because I'm not very good with jokes. What's a technical analyst to do? When most of us approach, I wouldn't dare say all of us, approach FX, currency trading, or really any trading of the day type variety, not the Warren Buffett type variety where he buys something and holds it for, until he retires, which should have been a few years ago, actually, at this point, by standards. We approach it through technical analysis. Technical analysis, of course, is nothing more than a record of past prices, but it's more than that. It's a record of past inclinations of the market. It tells you what the market thinks important, what levels are important. It has a good deal of value as a predictor in the sense that markets tend to do the same things, that markets are all the same way, and markets have all the same interests, basically making money. So if you have a long decline, you can bet that at some point, not whether it'll go up, but from what point will it go up? What will be the catalyst? What level will more people, who are after all short, that's why the market is down, will decide to take profits? It would seem, certainly since 2008, that the markets are now at the mercy, even more than before, of central banks, rate policy, comments, and events. Having been in the market about 25 years, since I got out of graduate school, I can assure you that what seems to be different is really not. What is different is the specifics, meaning what the central banks are actually doing, what people are saying. The events in the world are, of course, different. But the idea that markets were always at the mercy of central banks is not new, or at the mercy of statistics, which is really the same thing, because when you worry, when you sit up all night, or as I do, get up early, much as that is not part of my physiology, is something I've adapted to over 25 years. When you get up early to come in to see what non-farm payrolls are, the world moves on non-farm payrolls. The world used to move on the United States international trade data. The equivalency is almost exact. The market has always been subject to these items. And one of the things I think that is uncommon about currency trading more than other markets is that the institutional memory is shorter. What do I mean by that? Well, there are people who are people tend to come and go, I think, much more rapidly in the FX markets. All of us are retail traders. All of us did not trade 15 years ago because there was no place to trade. That's not true of, say, the equities, where you have a historical memory that is both institutionalized in the people. I don't mean the people are institutionalized. I mean that the people read history of the markets There are a number of classic books written about markets that you can all read. Confessions of a Stock Operator, I think, is one. These are the absolute classics. The other is Madness. I forget the name of it. Madness, Booze, Bubbles, and Bust, something like that. Madness, written in the middle of the 19th century, talking about market bubbles and things that went back to various items in the 17th and 18th centuries. So there's a long history there about how markets work. Less true in foreign exchange. I'm about the max. There are some people who have a few more years than I do, but not many, simply because the market didn't really exist. Currencies only really got trading even among the banks in the early 80s. I joined about 10 years after that. But for most people, it seems that times are quite different than they used to be. We all approach foreign exchange. I certainly used to when I was sitting on the trading desk at the various banks that I worked. Actually, I only worked for two banks, Credit Suisse and the Bank of Bermuda. You approach it through technical analysis. But technical analysis is of limited value unless there is also, and these are the most basic types of items involved in currencies, a fundamental view. When I first went to the trading desk back in, I don't know, 89 or 90, I had no clue what I was getting into. I knew almost nothing about markets. I think they hired me because I used to drive and own a taxi cab, and I managed to convince them that somehow currency trading and driving a cab are equivalents, and I could use my background in the front seat and transfer that immediately to trading desk. I'm still not quite sure why they bought it. They did, and so they hired me. But there was no way to learn except by sitting. It was essentially an apprenticeship with a graduate degree. You get a graduate degree from a major university, and then you start out sitting in the trading seat as an assistant, knowing absolutely nothing, and being berated by your trader anytime you made mistakes. And you tried to minimize those, and you did your best. But the point being, there was no way to learn about what you were doing. But one of the cliches, and I would ask, and I'd be either dismissed or given some type of cliche, which I recognized as a cliche and promptly ignored it, which was, of course, the wrong thing to do. There is truth in every cliche. That's why it's there. That's how it came about. And the one that applies to this particular discussion does not do with technical analysis, because it took me a few years. I was too busy sitting on a trading desk, hitting keys and making deals and trying not to make mistakes to have anything to do with technical analysis. I didn't start learning technical analysis probably 5 or 6 years later, when I was pretty sure I wasn't going to get fired. But that was, you have to have a view. I had no clue what they were talking about. What are they talking about? That just means very simply, if there is what it means is there is a general trend in the market most of the time. And that is something that you can use to help you make your decision as to whether to, in that type of trading, whether to close your position. Because our job, we were market makers. It means we provided the liquidity. Yeah, all of our lives are cliches. What you have, if you don't have children, have children. You want to see your life become a cliche, have children. A very good cliche. But you end up doing and considering many things and operating very much exactly as your parents operated. And that actually turns out to be a good thing. There are certainly, at least in my case, a few better people that I can emulate probably than my father and my mother, which is a good thing. Anyway, we were listening to we came back from DC yesterday, and because we wanted to show the girls the Capitol, and we were listening to a book from more than 100 years ago called Anne of Green Gables, which is about a lot of these items. Anyway, leave that alone. So the traders would tell me when they were mumbling or not yelling at me was, you might have a view. You have to have a view. I had no idea what they're talking about. And what they were really talking about was the fundamental view of what the trend is. That's why we're looking at this chart right here, and I'll talk about it in a minute. I have interpreted this over the years in a number of different ways, and I've written a number of things about this over the years. I speak of it as the market, and it doesn't matter whether the trend is logically based or not. Let me see if I think I have a good example of this one here, what I mean by logically based. Where's the 10-year? See if I brought the 10-year. No, where's the one with the, hang on, I have to find the one with the Fed. I have some, these are I'm going to use in a second. Did I not bring it? Did I not bring, sorry. Oh, here it is. This is the one I'm talking about. Okay. This is back. Oops, sorry. I've got to do the technical aspect here. Okay. Everyone, we're getting there. Hang on. Come on, Google. Okay. Everyone should see the long-term Euro chart about 10 years. The way I would talk about this, the way I interpreted and discussed this old cliche, you've got to have a view, was the market has a picture of what's going on at any one time. And until that picture changes, the market will continue to function and trade as though this is the view. The best example we have of this is back in 2008, right? And I know I've used this example before, but it's the best one that I can think of, and it's the clearest. The world was getting very ugly in mid of 2008, but nobody quite knew it, but you could feel the tremors running through the markets. The Fed had been reducing rates since late 2007, talking about, of course, the subprime crisis in the United States, which, by the way, when everyone pays attention to Fed predictions, the only thing Fed predictions are worth is the fact that people pay attention to them. Because as a factual or even a moderately approximate view of what is going to happen in the actual market, out in the real world, their views are largely based, they're actually based much more on what they hope to happen than ours are. I don't particularly care as a trader whether the euro goes up or down. I just want to make sure that I'm on the right side of it. The Fed very much wants the economy to get better. It very much wants institutionally for inflation to rise. So those desires predict their predictions much more than they ought. If someone in the private sector was hired by a bank to do economic predictions, and their record was the record of the Fed, they would soon be looking for another job because their record is really, really poor about predicting. So what their predictions are useful for is market perception. They are rather ineffective at predicting actual events. So, and granted, events are hard to predict. But being a public institution with enormous responsibilities and enormous amounts of criticism, their object tends to color their perceptions. Okay. So back in the summer of 2008, the Fed has been reducing rates for 6-8 months at this point. The ECB does what? The ECB raises rates. Now, why does this matter? It didn't matter at the moment because look at the euro back here. During this entire time, you're running on the carry trade, you're running on a stronger euro. The market perception, and this is the same as having a picture, having a view, was this rise in the euro. So one of the things that you have to keep track of, in addition to your technical exit and entry points, is when the general view might change, because it gets very difficult to ascertain day to day in what we're doing whether a particular statistic, a particular comment is one that changes the view. Here, we have one note, one comment, actually, which changed this entire view for the currencies. And I'm only talking currencies here. And that was that at some point after this, some point right through here, right after this rate increase here by Jean-Claude Trichet and the ECB, when the prevailing view in the markets, the picture was that the euro and the eurozone is not going to have any problems from the American subprime crisis. And since the Fed is reducing rates and the ECB was either raising rates or stationary and then raised again, buy the euro. That's the view. That was the market view. Well, Mr. Trichet came out and said at one point, and he said what seemed like an innocuous comment. Things might not, I think he said GDP, but I'm not sure the exact words. I haven't looked it up in a while. God, it was 16. God, it was 8 years ago. Anyway, it was 8 years ago. So it was 8 years ago. In case somebody wants to know, my math is really good. It was 8 years ago. He said that growth in the GDP in the eurozone is not going to be as strong as we expected. Okay, seems kind of innocuous, right? Kind of thing any central banker might say to his wife, to his children, maybe when he's walking his dog. He speaks to his dog. I sometimes speak to our dog. But the market totally crashed because that one comment in the background of all the turmoil that was going on at the time undermined the entire view. I'll answer that in a second. The entire view of the market as to whether or not Europe would have any problems. So from a technical point of view, this is one of the things that a technical trader must look out for. Now, how do you know this? You don't. But there is something that you do and all traders should do. You use stops. Because if you're totally blindsided, as you look at this collapse in the euro, and that looks like a lot of people got seriously blindsided. But if you use a stop, it doesn't matter. Yes, you've lost money. But we all know the key to trading is learning how to lose money. Once you learn how to lose money, then you figure out how to make money. It's very easy. So from a technical point of view, in which appears to be our central bank driven market, but in actuality, markets have always been subject to this type of change, sometimes sponsored by a comment, and more often than not, stemming from some perception or reality of something coming out of a central bank. But this is not new. Zero rates are new. But markets adjust very quickly to any particular environment. They form a picture. And when that picture changes is when you get the change in a trend. So for a purely technical trader, I don't think anybody should ever trade without stops. But I knew people who used to say that. They would say, I'm a trend trader. I'm a fundamental trader. I don't use stops because if I think the trend hasn't changed, then I'm going to stick with my position. That, as far as I'm concerned, is a foolish way to trade, and certainly now an obsolete way to trade, because there was no way to predict that comment from Mr. Trichet. And if you did not have stops in place, you got smoked, and you were probably out of business because that move, there was no retreat. There was nothing coming back from that move. Okay. Institutional traders, by and large, there are different types that we mean. If you have institutional traders in equities, a lot of these positions are positions that either the bank holds or the bank is taking. They are, in fact, long-term positions. Institutional trading in foreign exchange, and I'm not going to make any jokes about this, although I'm tempted to, are simply traders trading for institutions. Except for the size of their positions, and unless they're a high-frequency trader, the the technicalities of what they do, there isn't a great deal of difference. In fact, there's almost no difference between the analysis of the way you and I would approach it and the way they would approach the market. The only thing that is different is there are institutions, and I haven't worked for one for 15 years now, that will, because of the nature of FX, meaning that the vast, vast, vast majority of volume in foreign exchange is speculative volume, can and will look for inflection points where they think that the market may move because of its own technical predilections. Aside from a move like this, which is the reversal of this, and that trend was getting started, and you should not get in the way of it. But there are traders out there, who largely work for institutions, be they hedge funds. An institution is just simply not an individual in this case and has more firepower because they have more credit lines and they're able to take on larger positions. That will attempt at various points to influence the market. I don't mean influence the markets in any surreptitious way. I mean simply buy or sell a good deal at a particular point, knowing that or suspecting that if you can move the market through a particular level, then you will get a cascade effect. Because if it's say it's a support line that has existed for 3 or 4 months or 5 months or 6 months and been tested numerous times and always held. The logic being, and very simply, we all know this, below that, there are going to be at a certain point below that support line, there are going to be a lot of stops because everyone is banking on this particular support line to hold. So if you can, as it approaches, drive it through simply by selling a great deal into the market, there's a possibility that you can trigger all those stops that you suspect are down there. Now, do you know they're there? No. But trading is about increasing your odds of success. In a situation like that, the risk is worth taking. So there is that type of institutional movement that's out there as well. When you see a movement like this, you can never quite know what happened, but if it snaps back quickly, as stop-driven runs tend to do, then this doesn't mean that whatever the technical, whatever the fundamental, whatever the view was before that has changed. Okay. So let me go back to the chart I had up before, and we'll talk some more about this. Okay. Now this is our recent world. And I have some historical charts for this too that I'll use, but they basically make the same point. Now there's a lot of really nice there is a lot of really nice tradable volatility on this chart. Nervous, but tradable. The interesting thing about this chart, and this goes back to last year, is that the view of this period was not really determined by what the ECB was doing. In fact, the market was trading kind of against what the ECB was doing. The ECB, during this period, is cutting rates, going negative, increasing its quantitative easing, and the Fed is going the other way. Or at least the Fed will say it's going the other way. But the picture behind this is not quite as obvious as that. Because markets operate on assumptions. And even before this period here, we're looking at here, the ECB has been on the reduction merry-go-round, whatever you want to call it. They are going to reduce rates to take care of their economy, so they say, and all the other things that we know are behind it. But as far as the policy goes, there hasn't been any change in a year. meaning their intent and their policy is one direction. So what's the difference through this period here? The period, of course, as with all trades, all central bank views are two-sided. Since you're trading on two currencies, it is the euro against the dollar. It matters what both sides do. Obvious statement. But if you are not paying attention to the view that I started out talking about in the beginning, then you're going to miss this. The one-sided view of this is the ECB has announced more easing than they said they were going to do. We should sell the euro. That's not the case. And it's proven in front of us. The reason is because what was also going on at the time was what the Fed was doing. And throughout this period here that we're looking at, it's the Fed that is generating the movement, because the view from the Fed side is not determined. I mean, it seems to me, as to what we saw over the past week and a half, that the unanimity, which central bankers all love because they're all bureaucrats, nobody likes to stick out. The unanimity on the FOMC seems to be shattered. You've got Bullard and Lacker or Lockhart, although it was Lacker, I think, were out there saying the Fed could raise in April. Next week, you get Yellen right here, over here, this one right here. You get Yellen out there saying, well, speaking with the most dovish speech in memory, in recent memory. But as we're all traders, the memories are really short, so we can get away with that. That kind of dichotomy, that kind of different interpretations coming out of the Fed is very unusual. Of course, Yellen rules, more or less. Although, you know, honestly, the FOMC works by votes. And as far as I know, the chairman only has one vote. So the amount of consensus that comes out of the Fed is quite remarkable. We shall see at the next FOMC when they give you the statement whether or not you get a much more divided Fed. I mean, it would certainly seem like it. Now, I think what happens on the Fed is that dissenters on the Fed, by and large, not all of them, part of this is going to depend on personality, of course, tend to go along with the majority if the majority is obvious. So the institutional projection of the central bank is strong. A Fed that comes out with a strongly divided vote, 6-3, 5-4, whatever it is, would really send a shock to the markets, because you don't see that very often. But anyway, throughout this period here, although the ECB is policy would, and that's what they wanted to, right on this one right here, I remember tweeting, this cannot be what Mario Draghi wanted at all. But the ECB's policy is not determined. You're talking marginally by degree, whether they add a few billion here to quantitative or not. The view is not changing. That view is incorporated into the market. The market agrees with it. The market knows about it. There's no surprises here. Surprises were coming from the Fed. The Fed had been making noises for a year since they ended quantitative easing about raising rates. They finally got around to it back in December. And then they immediately started taking it back. They immediately came out with all sorts of comments and various people undermining the Fed's own projection. And, you know, I've heard Janet Yellen and others say, you know, those dot plots are not a projection. That's such nonsense. How could they not think that the Fed... Good question. I'll answer that in a second. Another shocker, you know. I sometimes really do think that central bankers do not understand markets. I mean, I know Mario Draghi worked at Goldman. I don't think he worked on the trading desk, but, you know, Goldman is at heart a trading organization. But there are other factors even beyond the purview and also beyond the impact of central bank policy. So I'll talk that question in a second. It's a fascinating question. I used to deal with this, I get to deal with this. I've been asked this a number of times, a similar question. Why was the yen throughout throughout the earlier part of the decade, last decade, why was the yen so strong? Well, part of it was the carry trade, of course. But it didn't make any sense with the economic fundamentals of Japan. So I'll talk about that in a second. Throughout this period, it's the Fed's uncertainties that are driving the markets. This huge run-up this is the 16th, December 16th, when the Fed finally, after agonizing for how long? It's like trying to get your kids to eat. I'm using too many children's metaphors, I know. I just spent the weekend down in DC with the kids. We had a lot of fun, actually. It is the official center of Washington is monumental, if anyone has not been there, in the way it's laid out, in the scale of the buildings and the scale of the area around the White House, between really the White House and the Capitol. It is made on a monumental scale deliberately. And so for the rat, it's very impressive. Okay. And I found it impressive. I'm an American, of course. So back here is when the Fed finally raises rates. The market doesn't do anything. Over here, we talk about it again. What happens over here? Dudley says, well, we're getting a little nervous about this. What happens over here? Janet Yellen last week. Well, we're worried about the world. Okay. By all standards of what the Fed, this particular Fed's policy seems to be a communication policy. I mean, frankly, there's a great line from The Lord of the Rings. One of the characters is Gandalf, the wizard, is telling this other character not to, the number of topics going into this interview with the steward of Gondor, if I remember. Topics he's to avoid. Don't talk about this, don't talk about that, don't talk about that. Finally gets to the end, he goes, you know what? It's better if you don't speak at all. It sometimes seems that would be better, that they should go back to the cryptic communications policy of Alan Greenspan, because they don't really know what's going on. And I'm not really trying to be critical of the Fed. I think what's happening is that their views are changing because the world itself is changing. I don't think the Fed ever had to pay too much attention to what's going on in China, that what actually happens if the Fed keeps raising rates, if the dollar continues to strengthen, and the ramifications around the world if this happens. The Fed has always blissfully ignored the rest of the world. I mean, I saw a number of things. The Chinese had stopped letting yuan depreciate. They said that it's strong. The yuan had gotten a lot stronger. For about 6 days, ending about a week ago, the Chinese set the yuan rate, the official rate, weaker and weaker and weaker each day for 6 or 7 days running. I read a number of comments. I don't pass upon the veracity of these comments, the accuracy of these comments, that this was a warning to the Fed not to raise rates. Whether that's true or not, I have no idea. But it is certainly conceivable within the juxtaposition of the policies of the two central banks. It is certainly possible that China does not want the US to raise rates. We shall see. We're all going to be here. But it is very clear that, and this is again something we're based on fact, that Janet Yellen did not want the dollar, did not want the markets speculating on what Bullard and Lockhart, or was it Lockhart? I can never get those two straight, said about a Fed increase in April. She clearly didn't want that because That speech for the Economic Club last week, I can almost guarantee was written after and in response to the prior to board members' comments. And at the same time, the Chinese are raising rates. So back to the view. So as a technical trader, the thing that you have to keep in mind is this view. What is the fundamental, based on economics, based on, it doesn't matter. It is the view that the market perceives, and you can find it. Okay, now let me answer some of these questions. That's a good question. I think, and it's very difficult to tell. I mean, I think that probably the greatest support for the Japanese yen has been money fleeing China, and perhaps Japanese money fleeing China and coming back into to Japan. I mean, I believe Japan is the biggest, it's either Japan or Taiwan, which is the biggest investor, overseas foreign investor in China. And remember what this could imply from a currency point of view. If Japan is going deeper and deeper into negative rates, what is the Chinese like? And this starts, and you assume at the moment, at the beginning, that a move into negative rates is going to be bad for the currency. It doesn't turn out to be. But what is the perception? Well, if Japan is going to do everything it can to weaken its currency, and which is failing, by the way, what is the likely response throughout Asia? Well, other countries which both compete and trade with China, with Japan, are likely to try and depreciate their currencies. Well, if China does a great deal of trading throughout Asia, which it does, and Japan being one of its primary, what happens if its currency appreciates, not because of anything it's doing, but because of the depreciative policies of its trading partners? So I think the markets thought at the time that the new policies coming out of Japan would have a likely effect down the road of forcing the Chinese perhaps to devalue, which they've not done so far. Although they did mention that those 6 days last week. I did not bring a yuan chart. I thought of it, but if you bring too much stuff, then the entire presentation gets diffused and you don't stay on the point, which I have a tendency to do anyway. So I didn't bring the yuan chart. So to me, it seems that the greatest logic for that is money seeking its home back in Japan. And that, of course, will drive up the yen. Since you have to repatriate, you have to end up buying yen. And there have been enormous sums moved out of China over the past, well, actually since August, when the Chinese did their surprise devaluation. You know, it's very difficult to know. The Chinese system is not particularly transparent. Actually, ours is not particularly transparent either on these topics, of the Western system. But to be sure, there are many profits that remain in China, local profits generated by overseas companies, for whom the controllers of this seem to be a very good time to bring the money back home. So I think that's it. If anyone has any other ideas, please, I'll be glad to entertain them. But anyway, I think that's it. Remember, markets don't always move, as with what we're looking at right here and what we've been talking about most of this time, the difference between what should a technical trader do. This move, if you look at it just one-sidedly and not as far as the Fed, this move seems to be lightly irrational. The ECB is reducing rates, the ECB is doing more quantitative easing, and the currency is weakening. Always remember that particular day-to-day movements can certainly overwhelm anything that appears to be a fundamentally based movement. Okay. Next topic. Or not next topic, but next question here. Will 10-year gilts rise on the back of this? I don't think so. If you're talking about Japanese interest rates, no, I don't think so. Gilt rates are the Bank of England has a much healthier economy than Japan, has a much more sensible approach to capitalism than Japan does not have the demographic problems that Japan does, and it all in all is in a much healthier state than the Japanese. So and does not have the enormous debt load that the Japanese have. So I don't think that this is going to affect them. You're still with what the ECB and the BOE are doing. The gilt rate, aside from the official big rate from the Bank of England, gilt rates will be very interesting as we approach, of course, the referendum on whether Britain is going to stay part of the EU. I don't really think the markets have quite focused on that yet. In other words, put another way, I think that there is certainly a lot more room on the downside if it appears that Britain votes to leave the EU. And if that is true, I think what we're also not seeing is the effect that that will have on the euro, because I think very much that is going to be a negative for the euro as well. But okay, so back to this topic here. This yellow line is obviously a trend line. This yellow line is another trend line. So once we got this move back here, as illogical as it may have seemed at the time, the market view is telling you that this tremendous move up in the euro on the ECB day, right? I don't think it was so much because the ECB didn't do as much as the market may have expected them to do. Those kinds of gradations in market expectation, in my mind, are largely fanciful. They are created by people who need to write copy, myself one of them perhaps. But I don't think they really enter into the way the market views things. Markets tend to be a bit black and white on things. So the ECB, but the ECB did to some degree what it was expected, fine. What this tells you right here, it explains the rest of this as far as market perceptions go. Even if you didn't agree with it, this kind of move is setting the stage for this. And even though there's a tremendous amount of volatility here, the range has been from, this is like 105.40 here, I think. Oh, wait a minute. It tells you right here what it is, 105.20. Okay, right here, you have had, what's that, almost an 8-figure move higher in the euro. So the technical aspect to this, if you're willing, of course, to take the risk, is that you then look for points to go higher. Now, the interesting thing about this move, particularly, if you take this, I don't think I brought a longer, let me see if I brought a longer euro chart. I did, but it's not good enough. Okay, we'll have to stick with this one. Through much of the period, this period here, right? Even though this enormous move came up to 110, if you ignore these days right here, you can ignore them. From December, this is December 3rd, if I remember. Yes, December 3rd to, this is February 3rd. This is February 10th, February 3rd. So December, January, February, 3 months. Good amount of time for technical provisions, technical analysis, the stuff that we do day to day. The market traded pretty much between 105, let's ignore that, between 108 and 110. not completely. Now, if you go back further, you go back to here, it traded between 105 and 110, okay? But from here to here, for 3 months, you're trading basically 2 figures. That's perfect technical territory. At the time, the trend could not have been that determined as it's been since then. But the bias was clearly in the market to take the euro higher, that the rundown was finished. That's what this tells you. So this movement here, this 4-figure run, if I remember what it was, which is huge by any standards, even by the old days of trading when there was, the interbank guys ruled the world. This move right here is an indicator of the change in view. Within that change in view, technical analysis plays its role. Its day-to-day role. Anytime, except for right here, that you bet on 108, you probably made money. Anytime that you bet against 110 through here, you probably made money. So even within this pronounced rejection of the prior view of a weaker euro, despite the Fed's newly invigorated quantitative easing and negative rate policy. Despite that, because of what the Fed is doing on the other side, you both have a change of view and an ability to capitalize on that through technical analysis. So the title, which was slightly facetious, what's a technical analyst to do? And the answer is quite simple, what we've always done, with a perhaps more frequent view and look over our shoulders. Because it used to be that Fed pronouncements and ECB pronouncements were few and far between, and except for the FOMC, they didn't matter a whole lot. Well, we're not in that world right now. We've got loquacious Fed policy. We have Mario Draghi promising to do whatever's necessary to save the euro. Sounds like Horatio at the bridge defending Rome. And he is Italian, by the way. That's true. Although I guess his view of the world was formed by Goldman. But anyway, so with more view over your shoulder as to what the people are saying, you operate pretty much the same as you would have at any time. Again here, Mr. Dudley, far more dovish comments than anyone expected. Of course, a week later, he came out and reversed them. So as I said, I'm not sure what the Fed is doing, maybe it doesn't know itself, with its back and forth on policy, but it has certainly complemented the policies of the euro. Okay, now, I said that I would go over some of the technicals. I'm only going to have a chance to do 2, but I'll be glad to do them today. And I will schedule a full technical session perhaps next time. Okay, there we go. This is the euro. Now, in part of the ways, this is the same chart I showed before, except I actually have some technical stuff on here. I have one anyway. My view of technical analysis is the more things and the more time frames, the more modes of analysis suggest one or other particular move, the more likely it is to happen, and the more you want to bet on it. So it has always been, as I used to hear Steve Nissen from Candle Charts say all the time, Candle charts are only part of the picture. Look at all types of analysis, bar charts, the old support and resistance that I tend to use because of when I was trained, technical indicators. I have only RSI up here. And the more of them that indicate a similar type of view, the more likely it is to happen. Think of it as if each indicator, each chart formation had its own fan club. Its own group of people who only listen to that. I exaggerate. So the more fan clubs you have for a particular lined up behind a particular move, the more likely it is to happen. So right now, if we look at now, always, of course, remembering in the background that Janet Yellen seems to have laid down the gauntlet, a cliche that stems from dueling days, basically, and nights. Ridiculous, but we still use it. It's like I had to explain to my girls what the phrase, why someone is a big wig, what that means from, what that comes from, and the phrase is 300 more years old. Anyway, let me just check here, sorry. Okay, so it would appear from this chart. So back, let's look at the picture behind it in the euro. There seems to be dissension on the Fed. We know what the ECB is going to do. We also know the market has factored that in. It doesn't matter. The ECB will probably have to come out, and I don't know what they could do at this point, to change the market's view that the ECB no longer making the determination about the view of what's going to happen to the euro. It's back to the Fed. So we know, despite what Bullard said, that April's a possibility, that I think April's not a possibility. You know, the Fed has created so much trouble for themselves by getting more and more specific with communication. The problem is the world changes. The Fed said initially, let's rehearse our memories, that when inflation gets, edges up towards 2%, our two goals are, originally I think it was 6% unemployment and inflation at 2%. Well, we're now at 5%. We were 4.9% inflation. That box is checked. And even their favorite PCE core is running at 1.7, having risen quite dramatically over the past 6 or 8 months, with CPI core over. So it would seem to be that having, in my mind, foolishly set specific standards, the data-dependent Fed, they're about as data-dependent. I'm searching for the right metaphor. They're not data-dependent, at least in any sense that you restrict the data to the United States. So if they're data-dependent, they should be raising rates. They're not going to. Janet Yellen and the board made it quite clear back in March when they reduced the dot plot, and more recently and more emphatically in my mind when Ms. Yellen came out and gave that incredibly dullish, did I say dullish? I meant dovish, but it was pretty dull too, actually, as are most central bank pronouncements. They're not in the business of entertainment or of raising excitement, at least not supposed to be. That is unlikely. Nothing's happening in April, although she wasn't specific about it. What it is that they're concerned about, they've already told us quite clearly. They're worried about the global market. They mentioned China. They're worried about China. Well, was that predictable 6 months ago? Yes, probably. Why didn't they get it? I don't know. I can't answer that question. But I can answer the question as to what I think they're going to do about these things and what it may mean for the euro. So if we look at the chart in the euro, it would seem that somewhere around here, around 114, we have a very plausible top. This, I could have drawn this line back here. It's not quite 114, but in the, this goes back more than a year now. Well, not quite here. Wait a minute. 1, 2. A little bit less than a year. Okay, we're in April already, so 11 months. Nothing above 114 except for a couple of spikes. The one thing about moves such as this, they usually mean that there's very little volume through there. The old cliche is gaps will be filled, meaning that because so little volume goes through, once you get back into the range, this belies that here. But if we ever got down to here, around 108, my guess is you'd get a pretty rapid fall for a figure or two, simply because there's nothing there, and you'd be below this level. But that's another topic, and we're not there. So it would appear now this is RSI. As far as oscillators go, it's my view that they all basically depend on one principle, and that's reversion to the mean. So it doesn't matter a lot which one you choose. They all have validity. And based on what you look at here at RSI, that the euro is essentially overbought. Does that give you any dates or any levels? No, not particularly. But it certainly has followed through. Remember, there is, of course, that feedback. Everybody who looks at an oscillator on the euro right now is going to read the same thing. It's probably overbought. And they're going to be placing short positions, new short positions, someplace between 113 where we are now and maybe 114.50 or so, or up towards 115, because those are some of the tops that we have here. So those coincidences are indicating perhaps that there is a view. If I ran a Fibonacci from here to here or from here to here, you'd get the same type of thing. Again, Fibonacci's are similar as to all of those kinds of tools, in that they tell you, especially in the case of Fibonacci's, they tell you that markets normally revert to prior levels. Why is that? Well, we all know that way. It's because the only way to take profits. And so the principle is inherent in the type of speculative trading that's involved in a market. The only way to take profits on a position is, of course, to close it, not to go the other way. And so it's an inherent feedback loop within currency trading that this will happen. So it looks to me that the euro is somewhat ripe, depending, of course, on the next comment out of the Fed. We have an April meeting. It'll be fascinating to listen to it. Ms. Yellen has said in the past that that they would never take a rate move at a meeting without a press conference. Again, to me, a foolish and unnecessary statement, because the markets if communication has a virtue, then it has to be consistent. And it is as clear as nothing else in the current world that it's almost impossible for central banks to be consistent. If the Fed didn't know, and it clearly didn't know, under Bernanke, that subprime was going to be a problem for the United States economy and banking, they didn't know. They clearly didn't know, because Mr. Bernanke said as much. He said, we have this contained. Probably not. So it is impossible to be consistent with your utterances about policy if you are more than occasionally blindsided by developments. We have unfortunately granted our central banks the idea of omniscience. They are not omniscient. There are a whole bunch of guys but there are a number of guys on Wall Street who made billions and billions on the collapse in 2008 because they saw what was coming and the potential, and the Fed did not. So we have the same issue here. So without a change in Fed rhetoric, or perhaps ECB rhetoric, it looks to me like the euro is slightly overbought here. Is that true? I don't know. We'll find out. Okay. Actually, I have one more thing I just want to cover. I'll be 2 seconds. This is the sterling. If you had to make a bet on the euro based on reversion to mean, it's actually close to the mean. So it's not that strong. It's slightly oversold, but very, very slightly. More important, what I would say right here are the historical trends on this particular trade. The sterling hasn't really been down here very long, nor has it been down here for many years. That would seem to imply, and you have a relatively strong, relatively speaking, British economy, that would seem to imply upside potential for the euro. Of course, the wild card is the referendum vote. The more that vote, and this is as obvious can be, the more that vote appears to tend towards dissolution of the bonds with Europe, the lower the euro will fall, and it will drag the euro down with it. Okay, folks, I thank you all very much for listening. I hope this has been of some use in your day-to-day activities in the market, and perhaps of some interest as well in your larger view of what it is we do and where it fits in the world of the markets and also the world in general. Okay, I will set no, I do not think we're getting parity on the euro just yet, although I still think that the dollar gets stronger, because in my mind, although I have not looked too good on that over the past 2 weeks, in my mind, the fundamentals cannot be denied. And the move that we've seen has been partially a reactive move to and I will do gold, I promise. If I don't set it next week, it will be the week after. Okay, I like gold. Gold's fun to talk about. Okay, thank you all very much for attending. I will put my email address in there if I can figure out how to do it. It shouldn't be all that difficult. And whoops, that's the wrong one. And I will see you all next week. Same time, as they used to say, same channel. Thank you, FX Street, once again for your facilities, and I wish everyone a good day. Take care.